Today we're here with Matt Lustig, the head of investment banking and the head of real estate and lodging at Lazard. Matt, thank you for taking time to talk to us.
It's my pleasure to be here.
Matt, you've spent your career advising public and private companies and giving them counseling on strategic acquisitions and the like. I'd like to start with that public-private distinction. So for real estate companies, what's the difference between a public real estate company and a private real estate company?
Sure. On paper, they're similar. One owns a portfolio of assets. The other one is public, which is to say its equity is owned by public shareholders and it's answerable to a public market. But in practice, the strategy and the way you grow equity in a public company is actually quite different than a private company. Most people understand private companies. The idea is to buy, build, invest in real estate that over time grows in value with cash flow or the timing of cash flow or the timing of that value creation being flexible. It doesn't matter. It's a good deal. You'll make money in the future. There's room for playing with your gut. You're using non-recourse financing, and the timing and ability to predict when and how much is less important. A public company, on the other hand, is a portfolio of assets, but it has a series of overlays that drive value. And in the public markets, if you're doing well, your shares trade at an attractive price, which means you can access equity capital that allows you to play in the acquisition or development game with an advantage to your peers. It's quite efficient to issue stock or debt, particularly if you're investment grade on the debt side. But importantly, public shareholders aren't looking for quick capital gains or even slow capital gains. Public shareholders, if you were to idealize how does a public company strategy generate value, it's important to understand, A, it's not at the asset level. It's at the share level. Management is typically paid based on the performance of shares. And in order to get shares to perform, what you're trying to do is build a company, a portfolio that is financed in a way that's risk-adjusted, that creates cash flow predictability over time and cash flow growth over time. If it gets too risky, effectively the discount rates on those cash flows go up and the shares go down, even though, despite that increase in risk, there may be more money to be made. And so the CEO and the board of a public company are much more focused on building, growing, risk-adjusted cash flows over time in the real estate business than they are on doing a good deal or making a big pop in a given asset. In fact, often that works against you because the unpredictability of how you make money can, in effect, change the multiple. So in the one hand, you're building growing cash flow and shooting for a high multiple on your earnings. In the other hand, you're really looking for a capital gains-oriented or a slow growth strategy without worrying about one-off cost of capital because you'll finance each deal on its own merits, not the company's merits.
So over the last 25 years, we've seen tremendous growth in just the asset base of public real estate companies. Right. How should an investor think about investing in a public real estate company versus, say, an asset or a portfolio of assets, even if those assets are stable?
Sure. Look, I think they can achieve very similar things over long periods of time, but maybe different investment objectives over short periods of time. I'm personally a big believer in the REIT model in the sense that getting real estate exposure through buying publicly traded shares gives you liquidity, typically gives you a very low-cost structure of operating, and you're betting on management. So and when you're buying shares in a public company, you're making the bet that management will operate the business in a way that builds value over time, doesn't detract from value. How do you detract from value? Have to issue shares at the wrong time because of over-leverage or imprudent capital management, making bad acquisitions. It's a dynamic company that you're buying. It's not a single asset. And when you reach the end of your holding period, there may be different assets and different cash flow structures and a different share count underlying the investment that you made originally. And so you have to make that bet. Having said that, there are any number of very large blue chip companies that will deliver or should be expected to be able to deliver higher performance from that portfolio of assets at lower cost with full liquidity than most investors can achieve on their own. Very large investors can buy and create portfolios of their own or make acquisitions of individual assets, which can also be very profitable. It tends to be a higher cost structure. To the extent you own the whole asset, you have control and a certain amount of liquidity as to when you buy and sell. And so if you're an institution that has sufficient size to create your own portfolio, or a specific view where you don't want a portfolio exposure, you want a particular corner or an asset, and you have the capability of adding value to that asset, that's a very valid way to do it as well. But for most smaller investors, it becomes somewhat inefficient and high cost to make smallish, which is to say sub tens of millions of dollars from an institutional point of view, investments in real estate.
So, a large part of your business is advising real estate companies on strategic transactions and giving them strategic advice. And I think that's one thing that we have seen in the real estate industry over the last number of years is strategic acquisitions or dispositions. What drives that kind of activity in real estate these days?
So typically what drives it is some form of sense that the company on a standalone basis isn't able, the seller, if you will, or the target, isn't able to drive an attractive cost of capital to continue their business, and so therefore can explore whether a combination with another comparable real estate company or a privatization might drive more value. So a lot of that is a calculation of whether combined co, if you will, is worth more than what the existing company might be. If it's a privatization, it's a number. You're selling for cash. There are tax consequences which can often be structured around for tax-sensitive owners or OP unit holders. But you're picking a moment in time when you sell for cash, basically saying, I can do more for my shareholders in this cash-out transaction than I expect to be able to do on a standalone basis, given how the market is valuing my shares. On a more strategic combination, there has been this age-old debate in our business, because real estate people like to debate such things, as to whether bigger is better. Mm-hmm. And the typical wisdom is better, which of course is right. Although there's a natural tendency over time for better companies to get bigger. They have a lower cost of capital. They tend to be the acquirers. They have management skills, talent, platforms that spread over acquired assets, can add more value frequently than the company which sold into. And so in many cases, bigger is better, but not because of sheer size. There are benefits of size. There are liquidity. There's index inclusion. The rating agencies prefer larger companies and diversity, and therefore cost of capital, which is the principal cost of goods sold for a REIT, can be minimized and therefore provide momentum in the company's business and their ability to invest. So there is virtues in size, subject to excellent management. And when you go beyond that, it's very situational. We are in really an early generation of REITs going public. If you went back 100 years, you had a series of industrial companies going public. It starts one way and it evolves into another. I would expect over the balance of my career that the public market value of REITs will go up very substantially yet again, because I think it's a superior form of ownership for a certain percentage of investable real estate, but it will take time. And as you migrate from founder-led and dominated companies to professionally managed companies, you'll see some M&A taking place, because often founders, if they haven't sort of dealt with succession in an appropriate way, don't have good choices, and often a merger is the best way to continue the business of the assets. That's in the traditional real estate space. When it gets into lodging, it becomes more interesting, frankly. Lodging, there are rapid changes in that business. There's more of an operating component and a marketing component, and there are pressures suggesting being very large and well managed is a potential sustainable advantage against margin erosion from the online travel agencies, and competing with formats like an Airbnb and having an ability to offer a broad offering of brands and locations where there's real stickiness in terms of the frequent traveler programs and being able to serve large customers across their needs. And there often it's a far more strategic combination where 1 + 1 equals more than 2.
So one of the things you said is that in the public real estate company space, better tends to get bigger. And I guess one thing that we've seen over the history of REITs has been initially we had between 1992 and 1999 or so, there was a proliferation in the number of REITs, but the growth post the early 2000s has largely been in the size of REITs mm-hmm. rather than the number. So is that pattern part of what you're seeing? That sort of we're seeing the better REITs are getting larger and consolidating?
I think that's absolutely part of the pattern. But we also had a period of time when money was free in 2006, 2007, and debt was free, and there was an oversupply, one would argue, of both debt capacity and equity availability. that caused privatizations of a number of large REITs. So you'll still have the cyclical move where when real estate goes out of favor subject to capital availability, and today the real estate industry has gotten really good at aggregating capital. It wasn't several cycles ago, it is today. You'll see investors with access to capital take advantage of cyclical lows, and the number of REITs will decrease. But over the course of time, management systems, technology, platforms, in fact, access to deals, the ability to add value will often accrue to much larger companies. So if you're quite large and you have the ability to put 5 to 10 to 15% of your assets in development and take risk because the rest of your portfolio is well leased, you can often grow NAV faster than a smaller REIT which couldn't put material amounts into development without changing the risk profile of the company and knocking down the stock. So when you get bigger, you can afford to invest more, better management, better systems, better technology, better understanding of your markets. In theory, that should be supportive for long-term growth. It won't always be the case, but it certainly has been.
So when the growth in the REIT asset base that you're expecting to come over the next decade or 2 decades, do you think that's going to come from further consolidation in the industries, or REITs taking over private real estate portfolios and gaining larger market share of the real estate asset base, growth in the underlying assets?
Yeah, I mean, I think it'll be all of the above, but I would guess the biggest contributor would be the acquisition of privately owned real estate into the public today. So the public owns somewhere less than 20% of all investable real estate. In certain property types, it's quite a bit less. In certain property types, such as malls, it's quite a bit more. But that's a reasonable overall way to look at it. So by far, the biggest growth is going to come from privately held assets transferred to public ownership, and there'll certainly be consolidation along the way.
So over the next year, so over the relatively short run, what do you see as the prospects for real estate M&A activity, taking public companies private, private companies public, any of those?
My sense is there'll be activity in all of those areas, but not a flood by any stretch because it's a more situational market. There's a feeling among real estate investors of real conflict. We're late in a cycle, depending upon how you define a cycle, and many real estate investors who've been in the business a long time start to get a little bit skeptical when you're in year 7, 8, 9 of an economic cycle. Having said that, and it's a very interest rate sensitive business in terms of capital availability and required returns and pricing, interest rates are still very low. Real estate is still attractive on a relative basis to stocks and bonds. There's a tremendous amount of liquidity globally. And so when you think about where do the giant pools of money go, real estate is still, I think, among the most attractive places to invest capital today, despite it being expensive by most historical measures. But frankly, bonds and stocks look more expensive, and in a diversified portfolio, there's a lot of capital that feels that real estate today is the best home for this vintage of investment capital, and so there will be activity.
So if I ask you to look over the next 5 years, what would your answer to the same question be, right? The prognosis for real estate M&A activity, and what would be the factors that would make it boom versus not boom? There'd be a lot of transactions versus not.
Look, I think more M&A activity makes sense than has happened, partly because of the tendency of companies that are independent to want to stay independent for a variety of reasons. So as the time frames get longer, I think the prospects for individual deals increase. The other issue that is facing the real estate business broadly and has strategic implications are the rapid changes in technology and consumption are causing obsolescence more rapidly in certain property types and locations, and therefore you're starting to see it's happened most visibly in the current moment in time in the mall business, where B and C malls are trading at a historically very wide gap to A malls. But you're seeing changes in this generation and the upcoming 5 to 10 years of how people shop, how they live, where they work, commuting patterns driven by driverless vehicles, enhanced penetration of the internet into daily life, that will change fundamental values in real estate. We are not great as investors, either in real estate or anywhere else, as far as I can see, in fully understanding and therefore pricing the impact of changes in technology and resulting obsolescence, which for the most part means enhanced capital investment required to get a given return, But that's absolutely happening, and sides are lining up as we speak about what the effect will be, but it's still not priced into the markets, and companies aren't strategically exiting those property types that seem a little more scary because the pricing is out of whack, and they're hoping some combination of low interest rates, capital into the real estate, they can avoid that. We'll see if that turns out to be the case, but you don't have sellers and you don't have buyers in large scale of the property types that are most obviously undergoing deterioration in underlying fundamentals.
Let's turn to the sources of capital now rather than just the companies. So for public real estate companies, have you seen an evolution in the relationship between shareholders and public REITs?
Absolutely.
Okay. And what would that be?
So look, this is true of all public companies, and it came a little bit later to REITs than it did to others. But a couple of things have happened in the public markets in terms of the mentality of the investors in public companies, thinking of themselves as owners and having the influence of new types of investment strategies affect the entire market and valuation. And by that, there is an increasing concentration of long-term held, in a sense, permanently owned shares, most typically understood to be index funds, but there's enough closet index money out there that it's a huge factor of folks who simply never sell major positions. Contrast that with the rise of activism, where the ability of individual shareholders pooled in a fund with a strategy to affect change, so that when you see persistent discounts in the real estate market today to underlying estimates of NAV, there's nothing easier on paper in the world. It's hard to get Coca-Cola to sell more bottles of something somewhere if you're an activist. It's not that hard to imagine, and you may or may not be right, by the way, that you can erase a discount to NAV in the public markets by simply selling the company, repositioning, changing the margins. But nonetheless, there's a group of investors who, many of whom are broad activists, have noticed the real estate industry. There's a handful of folks who focus on the real estate industry. But boards and management teams are now much more accountable to their shareholders on a real-time basis. And it behooves management teams, as one of the many things they do during the course of a busy week, to have very close understandings with those who own the company. So there's much more of a sense today of responsiveness to shareholders, and there's much more of a sense of accountability that if management isn't doing the job of generating a low cost of capital, read an attractively valued share price, that you can reasonably expect to hear from people about it in a much more aggressive way. That's changed really fundamentally the way boards and management teams think about the time they have to implement long-term strategies, and it hurts the cost of mistakes made in a company can be much more damaging today because people are held accountable in the short term. So it's a combination of more indexation run by governance people, which on the one hand, one might look at as passive, but it's not. Those folks are very interested because they're permanent holders in how a company is governed and run and how management decisions are made. And there's a sizable industry today of change agents who are looking for discrepancies in value and share price as an opportunity to hold management teams accountable and be a force for immediate change. That's certainly hit the real estate world, and I think life will not be the same for managements and boards going forward. I think that's a permanent feature of shareholder expectations.
Do you think that's different in the real estate industry than in other sectors, or is real estate just later to the party?
I think real estate is later to the party. There are certain elements of the REIT structure, particularly the Maryland basis and the ability to, without a shareholder vote, stagger the board, that gives real estate companies, the majority of which are Maryland incorporated REITs, certain takeover tools that can frustrate a takeover. But the fact is that's not really what's in it for most shareholder-induced activism campaigns. Really, it's about pressuring the board to change strategy or to sell it themselves, and the ability of public shareholders to exert pressure, particularly if a narrative on a company is created that's sold to the permanent shareholders, the closet indexers and the indexers themselves, who will vote in proxy fights if contested. That if the company loses the narrative there and there's a belief that a change in management of the board is in the interest of shareholders, it will happen despite the REIT structure. So it started outside the REIT structure. It started among REITs typically with externally advised situations that were viewed as particularly unresponsive to the common shareholders, or often had structural reasons why they might continue to be that way. But it spread to underperforming companies, many of which may have a good long-term plan to restore that performance, but get caught where the performance isn't yet, or the strategy isn't yet being valued in the shares, and investors think that they can accelerate the increase in share price by some strategy that they impose on the company.
So, I think of sort of classic REIT history, which is not all that long ago, as being one where you had controlling owners of private portfolios really liking that control. Mm-hmm. And so what you're describing now, if you have increased shareholder activism, do you think that will affect the public-private decision?
It could in some cases. And there are gradations in the REIT business, as in other businesses, technology being maybe the best example, of being public. So if there are super voting shares, or there's an OP unit, or there's a dominant shareholder where the founding family owns enough to frustrate a third party's efforts, that's a comparatively impervious structure to the public. But interestingly, those companies of that description as well have been attacked by activists because of the ability to simply put pressure and embarrass a company and wage over time, undermine their relationship with shareholders, and engage in battles to put directors on and start to influence over time, even if it's staggered. So we'll see.
So just to finish up, let's turn back to private real estate companies. Mm-hmm. So on the investor side, sources of capital, who is providing capital to private real estate, and what are they looking for from those investments and those companies, I guess?
So maybe the shorter answer is who isn't providing capital to the real estate business today. There was a time when the real estate business was dominated by defined benefit plans and certain insurance companies. That wasn't that long ago. And today, certainly the defined benefit plans are an important source, but structurally shrinking over time. And so increasingly there are vehicles that have retail, ultra-high net worth, sort of mass affluent, and the sovereign wealth funds, who are the big guys at the party, who dwarf the pension funds in terms of size, and who are increasingly interested in, and certainly have been for a number of years, in putting money to work in high-quality real estate globally, but certainly including the U.S. So capital is coming from everywhere. Real estate today is priced on a relative basis to other forms of investment, principally stocks and bonds of various kinds, which it didn't used to be. Right? No matter what the stock market was doing or the debt market was doing, good real estate was a 7 or an 8 cap way back when, and it didn't move that much. But frankly, the near elimination of inflation as an investment defense, if you will, in the real estate business, and very low interest rates and very high liquidity, or ways to play real estate debt and equity in a liquid way, have pushed us into a relative value world. And there we do pretty well. On a relative value basis, but it's been a maturing business. The companies are better today than they used to be. They're better governed, and they've been a very high-performing asset class for a long time.
Terrific. Matt, thank you very much for taking the time to talk to us. This was absolutely super.
Great. Thank you.
Okay, thank you.